forms that we had for the first and second roundtables. So you can see if this is your first roundtable with us, what we covered. Those roundtables that we previously had are recorded. So you can go on our website and grab those recordings if you want to re-listen to them. A couple of things we'll go through today. We're going to just recap a couple of issues before we talk about the 1094 and 1095s. So as far as ACA updates, there are no updates as far as the court case that's hanging out there. Anticipating we should hear something very shortly from that. In the meantime, proceed as if nothing changes. I know we still do not have draft forms out for our 2019 1094 and 1095s. That is a bit odd. Usually we have them in July or August. So we should have had them by now. Excuse me, I'm anticipating that the reason for the delay is due to the individual mandate not being in effect. That individual mandate is in effect for some states, so you'll want to make sure that if you're one of the few states that has an individual mandate, that you are filing the forms with those states. They do have a filing requirement for large employers in those states. So as far as the federal mandate goes, right now the 1095Bs are still required. Not sure if that's what the IRS is going to change and that's what the delay is. If the 1095B does go away, then most likely the third part of the 1095C, that is for employers that have self-funded plans, would go away as well. You're going to want to make sure as soon as those draft instructions come out, you read through them thoroughly because we did have changes this year with that individual mandate going away. So if the forms still look the same, be cognizant of what's in those instructions in case something changes. We'll try to get an e-blast out as soon as possible once we get those draft form instructions and have a chance to read through them if anything significant changes. As far as the ESRPs, we are still seeing ESRPs coming in for 2017. I think the IRS is finishing their 2016 ESRPs. So those are the letter 226Js that you would get if you had an employee that went to an exchange and qualified for an advanced premium tax credit. If they would have qualified for that credit and they were not offered affordable coverage with you, you would receive a penalty. Now, depending on how you filled out your forms will determine on the size of the penalty. If you offer minimum essential coverage to 95% of your employees, Sean will get into that a little bit later, you will be subject to the lesser of the two penalties. But what we're finding is people aren't filling out their forms properly, so they're getting hit with the larger of the two penalties when in fact they should only get hit with the smaller penalty. We'll talk a little bit about that when we get into the 1094s as far as what we're seeing for errors on that. Penalty abatement. Penalty abatement has to do with those ESRPs. There's also some other notices coming out. So employers currently are getting the letter 226J. And like I said, that's for 2017. Some of them are still hanging out there for 2016. I'm anticipating they'll start 2018, maybe end of November or beginning of December. And that is on the pay or play penalty. So if you get a letter 226J, that's again because someone went to the exchange and qualified for a premium tax credit. Excuse me. IRS is also sending out letter 5699s, and what those 5699 letters are those are letters going to employers that didn't file forms, and the IRS is saying, hey, we think you might be a large employer. Please let us know if you are or you aren't. You'll have to respond to that letter. Both the letter 226Js and the letter 5699s have a 30-day turnaround. The 30 days is from the date of the letter. So watch for those. Make sure that you either try to get an extension if the IRS will allow you an extension or get them responded to by that due date. The 972 CGs, we're also seeing some of those come in. The IRS started those, I believe, for 2017. I didn't see any of those for 2016 or 2015. And what those are is employers are getting those because they paper filed their forms when they were supposed to e-file their forms, or they paper filed or e-filed their forms too late. What we're seeing is some employers thought their forms were e-filed and were stuck in limbo, so the IRS never received them. If you are e-filing those forms on your own or through a payroll software, make sure you get confirmation back that the IRS received those forms so that you don't get one of those penalties. The 972CG penalty is a little bit more difficult, in my opinion, to get out of. So keep all your backup documentation as to when you mailed those forms in or when you e-filed those forms. Personally, if I was an employer who had less than 250 forms, so I could paper file, I would mail them with a return receipt to make sure that they actually arrived at the IRS's office. So with that, Sean, I'm going to turn it over to you to talk about the 95% test.
Yeah, thanks, Tonya. And again, with the paper and e-filing, one other thing, maybe it was said, is that the e-file requirement is those that have 250 or more forms. So if you have those or more, then you got to e-file the forms. Make sure you have that set up with your payroll vendor, or obviously we do that ourselves. We do it for a number of clients that maybe don't have that set up with the payroll vendor, and they do the forms. They just need them e-filed. We can do that too, or go through the process and get that transmittal code set up, which can take some time if you haven't done that. So yeah, the 95% test, at least to me, is a big area with the ACA reporting, because it gets to the question that's not on the form, but we spend a lot of time on as preparers, and that's, are you full-time? Are your employees full-time or part-time? So that's a big piece of the filing. As we touched on in the last two sessions, there's two methods to determine full-time status, and that's usually either use the monthly method, looking at hours each calendar month and seeing if they are working 130 hours or more a month. That's 30 hours a week times 52 weeks a year divided by the 12 months to get to the 130, if you're curious about the head calc. So seeing if they're at that number or more a month, that means they're full-time and need to be offered coverage. If you can still use, if you have a waiting period, you can use your waiting period and wait and offer coverage after a waiting period, which remember can't exceed 90 days, or for the reporting can't exceed 3 full calendar months. So you have a waiting period, implement that, and then make an offer after that. Otherwise, you can use the look back measurement period method again, which we've recommended in the last sessions and continue to recommend a 12-month measurement period. It's the easiest to administer, and it can average, because you're using 12 months and you have some employees that might be full-time some months and part-time other months, it can average them out over a long period of time, this being 12 months, and you can see if they're full-time and part-time, and then make your offers where you need to after that measurement period. So the 95% test is where it kind of came from, is the IRS said in the rules that if you're going to be a large employer, which we spent a lot of time in the first session talking about who's an applicable large employer and ALE. If you're an applicable large employer, you need to offer coverage to all of your full-time employees. And as they figured out, they were working on the regs, they said, well, substantially all is what we mean by that. And then when they further defined substantially all, that was further defined as 95% of your full-time employees. And we were looking at that, I guess, and going, okay, 95, is that an easy rule or is that a hard rule? And they set it up initially based on the monthly measurement method, because that was the only method that was there at the time. And then I think a lot of employers said back, well, that's not really fair, because we hire employees based on what we expect, not on what they actually worked when we're offering coverage. So there's a disconnect there between what we expect an employee to work and what they end up actually working. So then the IRS took that into account and brought in the look back measurement period rules, which I'd said is that 12-month measurement you can use to determine who's full-time and not. So the great part about the measurement period is it's flexible. The downside about it is that it's flexible. So there's a lot of rules and regulations around it, like we've talked about in the last session regarding rehired rules. Are they rehired within 13 weeks? And if they are, then you got to continue to offer coverage to them when they come back. There's a rule, a parity rule, that's like an exception to that rule, but you need to understand that rule also to make sure you're following it correctly. There's employees changing categories from full-time to part-time and part-time to full-time. There's a seasonal rule. We could have multiple webinars just on that topic alone, and I think we've covered some of that in the last one. But so you want to make sure you're offering coverage to 95% of your full-time employees in whichever method you're using. It's determined monthly, so each calendar month you want to make sure you're offering that. And if you don't, then on the 1094, which I'll get into, you have to change how your 1094 is reported, and that'll trigger to the IRS that you didn't meet that 95% in that, which I guess I'll get into. Kind of now it leads into the 1094 discussion. So on that 1094, on part 3, or the back page of, I think it's on the back page, there's part 3, and then there's a minimal essential coverage, or MEC indicator, and it's a yes/no question. And so if you meet that 95% test, then you can check yes in the boxes. So in the ACA reporting, there's usually an all 12-month box, and then there's following that all 12-month box, there's a calendar month following those boxes for each calendar month. So you can do either way. It looks obviously cleaner if you check all 12 months, if you do all 12 months. So we do it, and we recommend, if you're doing it on your own, to check all 12 months if that's the case. So if you met that 95% test, in other words, you offered coverage to 95% of your full-time employees for all 12 months, then you can check that all 12 months that you offered. And then that would indicate to the IRS that you're signaling to them that you met that requirement, that 95% test. So that's where that is. And I guess the biggest, a big issue that we run into, and Tanya, you've probably seen this more than me, is that when we run into these letters from the IRS, and there's these really large penalties that are on those letters, it's a lot of times because they didn't fill out this 1094 form on that part. They didn't indicate that they offered minimal essential coverage for all 12 months or any of the months. So then the IRS just looks and goes, okay, you're signaling to us that you didn't offer coverage to your full-time employees. You didn't meet the 95% test. So then we're going to administer the 49 ADHA penalty, or the pay penalty, which for this year, for 2019, just keep in mind, would be $2,500 times all your full-time employees, less the first 30, get the first 30 free. So if I have 50 full-time employees, and let's say I didn't check the box, I offered coverage to all of my employees, but I didn't check the box. Okay, I offered coverage. I paid a lot of premiums and all that. But because I didn't check that box, then the IRS is going to look at that and go, oh, you didn't offer coverage. So then they're gonna put in this letter that I owe $2,500 times the number of full-time employees, which I indicated on the 1094. On the next column over, I think it's column B, indicate the number of full-time employees. Okay, I'm 50. I have 50 full-time employees the whole year. So they'll go 50 employees less the initial 30. It gets me to, I can do that math. 20 times $2,500 would be a $50,000 penalty that they would assess to me in that letter. And then I would probably contact myself or Tanya, who's dealt with the letters more. Well, I got this letter. What's the next step that I do? I'm in a bind here because I offered health insurance, and I'm getting this letter from the IRS, and I don't understand it, I guess. And I don't know, Tanya, if you want to comment to that at all.
Yes, perfect. And a lot of times what we're seeing is employers are not filling out the forms either completely or correctly. And so if you don't fill out a box, it's anticipated, or the IRS takes it as a no. So if you leave that box blank or check no, that's where the large penalties come in. Now, Sean, I think I'm going to go right into the 1095 discussion unless you have anything to add to the 1094.
No, I think that sounds good.
Okay, so when we're talking about people leaving the boxes blank, I see that a lot on the 1095s as well. So when you're doing the 1095s, it's important to note that line 14, you're required to fill out either the all 12 months box or each individual month. You don't skip any months. So if you have someone that's hired partway through the year, let's say they're hired in June, you do not leave January through May blank. You do have codes that you fill out for there. Line 14, it's required that every single box is filled out, or the all 12 months box, so you don't fill out all 13 months. Line 15, if you're using a specific code that requires line 15, then you would fill out line 15, such as a 1E code. We'll get into that in a minute. It's important to note that when you're doing line 15, you put the dollar and the cents in there. So if an employee pays $56 even per month for the cost of single coverage, then you would put 56.00, and you'd put those again either in the all 12 months box if they were employed all 12 months and had the offer all 12 months, or you put them in each individual month. You don't use all 13 boxes. What we tend to see is that employers will put all 13 boxes in, or they will put down the cost of the family coverage, or they'll put down the total cost of the premium, including the employer and employee portion. And that is not what should be done. Line 15 is the lowest cost single plan that meets minimum essential coverage and that meets minimum value that you have in your organization. That's what you should put down as long as the employee has access to that plan. So if you have a couple different plans at your place of business and all the employees can choose from both plans, you'd pick the lowest cost plan that meets that, and that would be the price that you would put in there would, or the dollar amount that you would put in there would be for the self-only coverage, regardless whether the employee took employee plus dependents, employee plus spouse, employee plus family, whatever they chose, you'd put in the single premium. So all of your forms, as long as everybody had access to that same plan, line 15 would be the same. Line 16 on your 1095-C, I to think of that as your excuse code. It's actually your safe harbor code. It's your safe harbor. Why did you do what you did? Why did you offer what you did? I tell clients, think about it as your excuse code. If someone waives coverage, do you have a reason why you should have a safe harbor in there? Because if you don't have a safe harbor in there, other than if you use a 1A code or a 1G code, talk about those in a minute. If you don't have something in line 16, you and that person goes to the exchange and receives a premium tax credit, you will be assessed a penalty. But you want to make sure that you can fill out line 16 when and if possible. We'll talk about that in a minute, but first let's go through our coding. What I listed here on that you can see in the presentation, those are the most common codes. A 1A code, that's telling the IRS that you offered a plan that met the federal poverty line. That means that for 2019, that employee's cost of coverage was $99.75 or less. So remember, these forms, although you're reporting on a calendar year basis, if you have a fiscal year plan, obviously you're going to have 2 years you're reporting on for that fiscal year plan within this calendar year form. So the federal poverty line for the 2018, if you have a fiscal plan year, would be $96.08. What's nice about that 1A code is if you put in a 1A code on line 14, you do not enter anything on line 15, and you do not need to enter anything on line 16. It's already deemed affordable because it was such a low offer. I mean, the employee is paying such a low amount. So you don't need to. Now, I have some clients, they're hesitant. They're like, well, can we, if our software automatically puts it in there? I said, well, it's not wrong if you want to put a safe harbor in there. If you want to use, if you're using a 2F, a 2H, or a 2G, you can put that in for a 1A. It's not wrong, but it's not necessary. And I like to think of it as less is more. If you're not required to give something to the IRS, then don't give it to them. It's just more chance of error on your part if you make a mistake in putting those codes in. So the 1A, that's kind of the best of the best. If you can use that, by all means, please do. It's easier and it's simple. Now, I didn't put a 1G code in here because a 1G code is often misused. People aren't using it correctly in various situations. What a 1G code means is a 1G code, it means that someone was not a full-time employee any month of the year. So then why would you give them a form? You would give them a form because you have a self-funded plan and they are on your plan. So when you read through those draft instructions, once they come out, take a look and see if the 1G code is still out there. If we don't have to report Part 3 on the 1095-C, we wouldn't need to report the 1G codes because we are only reporting those for employees that are not full-time. They could be someone who's retired. They could be someone that's on the board of directors, but they take our health insurance. And since we're self-funded, we have to give them a form to check the boxes in Part 3 for the months that they had coverage. Again, I'm suspecting that might be gone for 2019. Hard telling. There's been no indication from the IRS what they're going to do. So read through those, see what they're doing with that self-funded portion. So the next common coding that we see is a 1E, 2C. And what that is telling the IRS is it's saying, hey, we made an offer that meets minimum essential coverage and minimum value. It was offered to the employee, the spouse, and the dependents, and it was not a conditional offer. And that employee accepted coverage. So 2C means they accepted coverage. Now remember, for these codes, the 1A, the 1E, those codes, that offer has to be out there for the entire month. So if you're one of those employers who offers insurance right on the 91st day, obviously you're getting an offer of coverage mid-month. You cannot use a 1A or a 1E for that month because that employee didn't have the offer for the entire month. So again, if you're using those, you make sure it's all days of the month that offer's out there. Same with the 2C, I have to have coverage the entire month to use that 2C. The 1E, 2F, that's an offer that meets minimum essential coverage and minimum value, again, offered to the employee, the spouse, and the dependents, and there's not a conditional offer out there to the employee spouse. The 2F is for a W-2 safe harbor. Oftentimes what I see is I'll see, excuse me, I'll see employers put in a 1E, 2C. Now remember, with a 1E, we also need line 15 entered. But we're just talking about the line 14 and 16 right now. So I'll see a 1E, 2C, and then employees that waive coverage, the employers will put in a 1E on line 14. They'll put in the dollar amount on line 15, and they'll leave line 16 blank because that was the default that their software did. Remember, software is great, but the only problem is the output is as good as the input. So if you're not inputting the correct information, the output's not going to be correct. And they're leaving that blank. And I go back to those employers because we review forms that employers prepare using a software before they get filed with the IRS. And when I review those forms, I say, why did you leave? You put a 2C in, but if they are taking your coverage, those aren't the employees that are going to potentially go to the exchange and receive a premium tax credit. It's all your employees that waived coverage. And all your employees that waived coverage, you're not putting a safe harbor in. Those are the employees you definitely want to put a safe harbor in. And they said, well, all the employees that waive coverage, our software isn't putting anything in. I said, well, you need to have either a 2F if it's affordable, or if you're using a 2H rate of pay. So the W-2, if you're using that, goes on box 1 of your W-2. Remember, box 1 does take into account pre-tax items. So be cautious of what that employee is pre-taxing. An easy way to do it is to look at what the lowest employee is being paid on their W-2 and see if it's affordable for that employee. Then it would be affordable for all the employees. Rate of pay is your 2H. Now, whether you use a 2F or a 2H, you have to use those consistently with like kind of employees. So if Sean and I were doing the same job and we were both employees, we would have to both, our employer would have to use a 2F for both of us or a 2H for both of us. So rate of pay, here's what I see being done wrong on the rate of pay. I'll have employers say, okay, well, they work about 160 hours a month. So they'll take the 160 hours a month times the rate of pay times the percentage. Well, you don't use 160 hours a month, you use 130 hours a month. And that 130 hours is used regardless what that employee works. If that employee works 160 hours a month, 200 hours a month, or 100 hours a month, you're going to use that rate of pay of 130 hours a month. The 1H, the 2A, that is if an employee didn't work any day of the month. So remember in that prior example where I said someone started in June, what I often see being done is that the employer will start coding that form in June. Well, January through May, that employer should have a 1H, 2A in those months to tell the IRS they weren't working for me, so I didn't have to have an offer of affordable coverage to that employee. So make sure you're putting in those 1H, 2As. Again, I can't work any day of the month if I'm using a 2A. 1H, 2B, Sean, I don't see this being used a whole lot. This would be for your part-time employees. Maybe they're part-time and you have a fiscal year plan and they're part-time for years and years and years. And then partway through the year, because of you have a fiscal plan year and you're using that look-back measurement method, they hit full-time status. So before that, they would be a 1H, 2B. Again, Sean, I'm not seeing this a lot in the forms that I have. I see it a little bit, but not a lot. Is that about the same for you?
Yeah, not a lot. I agree, Tanya. I think it's just when, yeah, an employee is changing status, they're becoming full-time, and they've been part-time historically, and then just to kind of show, oh, they're part-time, and then there was a switch, and you as an employer caught that they switched to full-time, and then you made an offer after that, or maybe if an employee switched from full-time to part-time, there's depends on your method, what you're using. Remember, if you're using the measurement period rules, one of the catches about that is if they're in a stability period, you need to wait 3 full months before you can stop offers for part-timers. So we see that as a error in the coding sometimes, but no, not a lot, not a lot on that one.
Okay, and then the 1H2D, the 2D is actually for your limited assessment period. There's 6 different ways you could be in a limited assessment period, but the ones that we see most are the first month of hire. And I see a lot of employers saying, oh, the first month of hire, I'm going to put a 1H2B because they're not really full-time that month. That's not true. Your first month of hire should be a 1H2D. And then if you're in a waiting period, so let's say I have a 90-day waiting period, that waiting period would be a 1H2D, including those months where maybe I have a waiting period and I get offered coverage the 91st day. And if that 91st day, let's say, is April 21st, I would use a 1H2D for the month of April because I didn't have an offer the entire month. 1H2E, that is for those union employers. So in 18, and as well as the earlier years as well, we would be able to put in a 1H2E if you were a union employer and had to pay into the union for those full-time employees. You still have to give those full-time employees a form. I know there's a misconception out there that says, well, if I have union employees, the union dictates what I have to do, so therefore I don't have to make the offer. I don't have to give them a form. But because they're full-time employees for you, the way the rules have been set is that you still have to do a reporting on them. You have an easier reporting. You can put in a 1H2E for the months that they were on working for you as a full-time employee. Now be cautious. That could change in our 19 forms once we get those instructions out. I was thinking they would get rid of that soon, just because it's an easier reporting. It kind of lets the large employers wash their hands clean of what they're doing with those union employees. However, we still had that last year, so read through your 2019 instructions and make sure we still have those codes. Again, we're talking about the 1H2E codes. Sean, did you have anything to add to that?
Just back on the rate of pay in W-2, just a software note, since we do have a software model that we have that if you are running into issues with that and want to talk it off someone, obviously like Tanya said, you can talk to her, or someone at Eide Bailey about you're seeing 1E blank and you're not seeing a safe harbor going in for those waived employees. And then also like proactively going forward, if you want help and want to move towards something else. I mean, our software does it. So if you're looking for someone that has a tool that's more encompassing around that, our software puts in those safe harbor codes 2F and 2H for those employees that are offered affordable coverage. So we have that capability. And it's really helpful. Some employers maybe missed that. Tanya said it earlier, but maybe to reverberate that, look at your lowest waged full-time employee and see if it works, see if it's affordable under either method, and if it does, then you can use it across the board for your full-time employees.
Perfect. Any questions that came through in the chat box that you can see?
Yeah, we do have one question that came in. We have staff that work as needed and may qualify for ins per diem worked in different months. We usually use the 1H2B codes for these individuals. Are those correct coding?
Well, it depends if they're full time or not. So if they're hitting 130 hours a month and you're using the monthly, then they're not deemed full time, and then you can't use a 1H2B. If that's the case and they hit 130 because you're using the monthly and you didn't make an offer, their code would actually be a 1H blank, telling the IRS that you made no offer and you don't have an excuse why you didn't make an offer. Now, if those individuals are deemed variable, you're using the look back, and they're not hitting 1560 for the year of the look back, then you wouldn't give them a form. So it really depends on the months that they are. If they're part-time for the months so if I'm using the monthly method and they didn't trip that 130 number, then you're right. Then you would use a 1H2B for those months that they're under 130. but you wouldn't report on them unless they had at least 1 month that hits 130.
Yeah, I think the look back is very helpful in that for those employees. I know a lot of different industries have different workforces, and I've seen that in healthcare or just industries that have college students that come for the summer or for the month of December, something around just holiday hours. That you could then, like Tony said, under the monthly method, you might trip the 130, and then, oh, as a result of that, now I have to offer coverage to them. That's true under the monthly method. So it's easier kind of to understand, but you run into these issues like like what was brought up, where you would have to make an offer to an employee that worked for you maybe a month or just two. Now you do get a waiting period, so you can put in a waiting period if you haven't done so for that employee over that employee's employment life since they've been hired to termed. If you haven't used a waiting period, you can still use one, but then you have to make an offer right after that. So there's that. And then if you use the measurement period, yes, it's harder to understand and administer, and there's rules around it. But when you do that, like Tanya said, then because you use that measurement period, that employee would be over 12 months, would not be full-time, and would not need to get a form.
Yeah, the qualifying offer and the 98% offer. So what that question deals with is the 1094. If you look at line 22 of the 1094, box A of line 22 is your qualifying offer method. So if you're using that 1A code and you're meeting that federal poverty line, and you're doing that for at least one employee for all 12 months of the year, you can check that box. The 98% offer method, that is if you offer your employees coverage that's affordable, meets minimum value, and you also offer minimum essential coverage to their dependents, and this is being done to 98% of your full-time employees, meaning you're offering 98% of your full-time employees affordable coverage, and you're also offering it to the dependents, then you can check that box 22D. Benefit of checking box 22D is that you don't have to, on the second page, record how many full-time employees you had for each month. And remember, less is more to the IRS. If you don't have to report that, it's better to not report it. Line 22 also says check all boxes that apply. Back in 2015 and 2016, we obviously had 22A, B, C, and D. And I had employers that were always hesitant of checking more than one box. But the instructions do tell you to check all boxes that apply. Anything to add to that, Sean, or are you ready to?
Sorry, I was unmuting. Yeah, I think that covers it. Yeah, less is more. Just when you're checking those, make sure that you meet those definitions that Tanya that you laid out.
Okay, so I'm sorry for keeping everyone on a couple minutes extra, but we just had one more question come through, so let me answer this quick so he can get his forms done correctly. The question came through and it says, if someone leaves mid-year and we have to fill out all lines on line 14, what would I put in line 14? So let's assume that I had an employee that was full-time and left on April 15th. So depending on if they had coverage the entire month of April, let's assume they did, I would put a 1E, 2C. Then May through December, they weren't an employee any day of the month, so I would put in a 1H, 2A. Those would be my codes for May through December. If my coverage ended the day that I left employment, then I would put, if I left on April 15th, I would change that code from a 1E2C to a 1H2B as in boy. May through December is still a 1H2A.
I think there's a question on the chat too. I mean, people can, if you need to go, you can log off since we're past time, but I guess in the interest of answering questions that came up, since it's a Q&A, I don't know if you saw that one in the chat, but there's an individual who is full-time, it says until 10/1/19, intends to be part-time until 4/1/19. Seems to be a date in order or something. Well, I'll keep going. We understand that we need to continue to provide coverage due to our 12 months. Thanks, 2020. We have to provide coverage due to our 12-month look back. What change in codes are needed for the part-time month? So this situation is under the look back measurement period rules, full-time employee, and then changes part-time mid-year, or changes from full-time to part-time on 4/1/2020. So then you're probably correctly offering coverage because they're full-time due to the standard measurement period for January, February, March, and then April 1 they changed. So then on April 1, they're changing categories from full-time to part-time. So then you there's a rule around that that says you need to offer coverage for 3 full calendar months following that change. So 3 full months on 4/1 would be, or on April 1st be April, May, and June. We need to continue to offer coverage to that employee. And then on April, May, June. So then July 1, you can stop offering coverage to that employee at that time if you want, or if you continue to offer, you can obviously continue to offer coverage if you want. So that's what actually happens. So what the codes are is the offer codes happen in January, February, March, and April. And in May, June, April, May, and June, you're continuing to offer. Some employers we've found have done a COBRA offer on 4/1 of 2020, 4/1 of 2020 when they switch categories. And we've gotten clarification that that's fine. You can continue to do that if you want. So you put 1E, then the COBRA premium would go on line 15, the single premium. Oftentimes that's 100% of the premium for COBRA. And then that's probably not affordable in most cases, so then you wouldn't use an affordability code on line 16. So you would have that, so the offer would continue for April, May, and June, and then July, you would put, if it's a part-time offer, I'd have to.
Then, yeah, if you go for July, then that offer, once they're on COBRA, you would put, if they're, and sorry, Sean, I interrupted you, but if you go part-time, your coding would be a 1E, the COBRA offer, and then you would put in your 2B code because they're part-time. If they terminated coverage, then that COBRA offer turns into a 1H2A. Let's say they terminate coverage on July 1st or terminate employment on July 1st, that COBRA offering is different. That's a 1H2A. So one more question real quick, Sean. I have someone asking, is affordability based on individual or family if they are married? That's a good question. I see forms being done all the time that clients will use a 1C, 1E, 1D. That line 14 is based on what you're offering, not what the employee takes. So if you're offering an unconditional offer to the spouse, the employee, and their dependents, and that meets minimum value, you're going to put in a 1E code. Yes, that is a code that's used for that offer to the employee, to the spouse, and to the dependents. If I'm a single taxpayer that's working for you, that offer is still available to me. If I get married, I can bring that spouse onto the plan. So you're going to use that 1E for everybody, and the cost is the cost of single coverage, not anything to do with a family coverage. So again, it's always being reported just on the employee for line 15. So with that, we will wrap it up. Thanks for everybody who attended. I'm sorry, I have one more question coming through here. Just to clarify, if we check box D on line 22, we don't need to fill out the number of employees on the second page. True and false. You need to fill out the total employees, just not the full-time employees. That's another error we see being done on these forms, is that people will say, hey, I've checked box 22D, therefore I don't have to fill out anything on page 2. Well, the IRS will catch you on that, because if you don't fill anything on line 2, they'll see that minimum essential coverage box was missed and that the total employee count was missed. The only thing that gives you is the opportunity to not have to fill out the full-time employees on that second page. We do offer a review service. So if you want your forms reviewed, if you're preparing them internally, send Sean or I an email and we can help you out with that. But other than that, Amy, we will log off. Sean, thank you for traveling down here and doing the webinars with me. I really appreciate it.
Yeah, no problem.
Awesome. Thank you all so much, and I hope you have a great weekend.